Boom. All right. It is go time. There we go. Now we got Jim on. I got the Facebook Live going. What is going on? It is Tuesday at 11 a.m. So it's time for us to talk about multifamily. This is all about multifamily. I appreciate you tuning in. If you're joining the Facebook, member of the Multifamily Code program, welcome. If you are joining in and you're going to watch this from Zoom because you're part of the Multifamily Code meetup group, welcome. I'm glad to have you here today. So we got a lot to cover in just a little bit of time. Christian, welcome. Jason, welcome. Jim. So I was running around earlier. I had to go lock my kids out. You know, I got to make sure that they don't come in here and destroy the whole setup here. So I had to make that quick run. But glad to have you on today. This is very much interactive, right? So don't want to just sit here and run my mouth to all of you and whatever. I like getting your feedback. I like knowing if what I'm saying is clear. So Jim, you got your camera on. If I'm completely off base, just give me a sign or something. Tell me to cut it out, knock it off or something. But no, we have a lot to talk about today. Interesting time in our economy right now. So if you are in the multifamily space, if you're buying real estate at all right now, you sort of have this dilemma about what's going to happen in the market. Should you be buying? Is now a time to buy, or is now a time to sort of play it safe, wait on this crash that could or could not happen? A lot of trepidation going on right now just about the market. So I want to hop in and make today's topic all about that. So we've got a lot to cover in a brief amount of time. So I'm going to dig into this and sort of get started. So also before that, I'm going to be sharing some of my opinions, and that's all this is my opinion. I'm not a financial expert. You'll probably be able to tell that a little bit. I'm not an economist, but I do look at these things because it does have an impact on my life. And if you're invested right now, it will have an impact on your life. So you want to pay attention to that. So for those who don't know me, who might be new to this platform, my name is Jay Stubblefield. I've been investing in multifamily since 2015. Portfolio grew to a little over 1,000 units, and then we started selling some stuff off. But it is a career path of mine. So now I host events like this. I try to share information with others because I love connecting with other people who like buying apartments. So I'll go ahead and do a quick screen share. You will see here, if you can, hopefully you can see my screen, but this is my company website. If the text is a little bit small for you to read, that is SNS, that's like Sam, Nancy, Sam, capitalpartners.com. If you go to snscapitalpartners.com, you can read a little bit about our company, see what we do. We got testimonials of people who work with us. And also, if you are interested in hearing about our investments, we got some deals coming out pretty soon. If you want to hear about those deals, then we'll need to have a connection. I'll need to speak with you, see what you're looking for when it comes to your investment criteria and if it's a good fit. But if you go over to the Invest tab of snscapitalpartners.com, go to Invest, you click on Join Now. That's a brief form for you to fill out. That'll put you into a database. I'll reach out, we'll have a conversation and see if we have opportunities that may help you enjoy the benefits of investing in apartments passively. So we have people from all over, right? There are some people who are brand new to multifamily. There are also people who have been doing this for years. And so I'm going to try to keep this talk high level enough so that people who are definitely knowledgeable and in the business understand and they're getting value out of it. But I'm also going to try to simplify things a little bit for those people who may just be getting that information. And it works for me because I only understand things if they're fairly simple. All right, so here's the climate. Let's go ahead and set the stage. We have the recession numbers that came out, or the lack of the recession numbers that came out last quarter. We've got the Fed that is increasing interest rates. It continues to go up, and there's a lot of uncertainty in the market right now. So let's go ahead and just talk about it. And at the end of this, I really want to give a recommendation. I really want to set the stage right now so that if you are trying to determine what you want to do in your investment career going forward, that after you hear this talk, you understand that you have a clear picture of sort of what's going on right now, and you can make the best decision for you. With that being said, I want to go ahead and share my screen right now. And I want to let you all see sort of my world. I gotta move this around. So can you all see my screen? If you can, just put something in the comments or shake your head or whatever. You can see this beautiful. All right, Jim's got a thumbs up. Here we go. This is Jason's beautiful. I mean, this is. I did well. I did well to putting this together, but this is Jason's version of an economy, right? And so before I really get to what's happening right now, you sort of have to understand what's going on in our economy, and you can't understand that unless you understand how our economy works. So I'm going to briefly try to run through this so that you can understand what may happen. So first principle of understanding the economy is that everybody's income is somebody else's expense. Every dollar you spend is somebody else's income. So understanding that, it can sort of shift your mind a little bit into how an economy works. And so the way that I understand things is I have to break it down and just make it real simple. So apologies if you are, if this is too simplified for you, but this is the only way I can sort of make sense out of things. So in our economy, we want to start off on the far right. We got Larry, the landlord. Okay, so Larry is a landlord, and then he spends his money at the big box store. So if we want to just tell that, let me get my here. Pop. All right, so flow's going this way. So Larry's taking his money, going to the big box store, and he's spending his money there. The big box store employs Terry, the tenant. So Terry, the tenant, works at the big box store. He gets his money, and then he pays his rent to Larry, the landlord. And so this is our economy. Very simple, very simplified, right? So Larry gets his money from Terry, the tenant. He then takes some of that money. He goes, buys his goods in order to run his property. He shops at the big box store. The big box store employs Terry, and we sort of keep on in this fashion right here. Now, ideally, the United States wants inflation at about 3%. So in a healthy economy, what happens is this just goes up every year. So if we go around this little loop, well, pardon that, but if we go around this loop, we will see that, say Larry's doing pretty good. He wants to make some upgrades to his apartment. So he spends a little bit more money at the big box store. The big box store does well because they have more income. So they give Terry a little bit of increase on his job. That increase in his job allows him to have more income. And that's how Larry, the landlord, can increase the rent. So ideally, economist says we want all this going up by, let's just say, 3% a year, right? So we want that going up at 3%. Everybody follow me, right? I think this is pretty simple so far. All right, so we just keep all of that going at 3%. That's a healthy economy. Year over year, if we do that, we're sort of on track, right? We've got a good economy with just continuing this flow of money at a healthy 3% per year rate. All right. But now let's say something goes wrong. Let's say we get some ugly little event right here, right? Some dangerous, let's call it pandemic virus, and it just starts throwing virus all over the place, right? And so now what happens is Larry, the landlord, doesn't want to go to the big box store anymore. So he's not spending that money. All right, so let's just go ahead and see if we can get rid of some of this. So Larry, the landlord's not going to spend this money anymore. And things start going the wrong way. So we see like this is just going away and we're not making this money anymore. And instead, we actually start going in the opposite direction. So instead of the economy growing by that 3%, it actually starts going wrong. So this flow is now in the red, and this flow will make it a little bit shorter, right? So Terry's getting less money, and because of that, he's going to get less money. So let's just explain this a little bit. So Larry doesn't shop at the big box store that much anymore. The big box store doesn't have as much money. So they come over to Terry and say, hey, Terry, we're going to have to cut your hours back. Instead of you getting 40 hours, now you're going to get 32 hours, right? So that eventually harms Terry the tenant. Terry the tenant spends less money with Larry the landlord, and now he doesn't have as much money. If that keeps going, though, we go through that again. Now the big box store may say, hey, Terry, not doing too well. We cannot employ you any longer, right? Terry gets laid off. Now Terry definitely doesn't have any money, and Larry, the landlord, gets less money. So he shops at the big box store even less. All right. So that's the economy in a nutshell. So what happens? What can our government do in order to keep us from staying in this death cycle, right? The downward spiral of negativity where the economy is just going less and less and contracting. So over here on the right, you got the Federal Reserve, and you got this little the little house right here. That's our capital, right? So compared to the Federal Reserve, they are relatively small. I just drew it like that. But anyways, so you got the government and the Federal Reserve who try to help us. And so over here, they have two methods. Important for you to understand. There's only two ways that they can help either grow or contract the economy, either to stimulate the economy or to cause a contraction. And that is by interest rates. Okay, so their job is to really look at the economy to understand how it's working and then do what's best for the economy, given with their tools, with the tools are interest rates, and we have money, which would be money printing, or the nice term that they call it quantitative easing, or you can have quantitative tightening, whatever. So these are the ways that they can affect the economy. All right. So how does that work? So let's say we're in this downward spiral right now. We got some virus spilling all over the place, right? So they'll say, well, let's come in here and let's drop our interest rates. So let's say interest rates were at 8%, and that went all over, but whatever, we'll follow here. And they're going to say, well, we're going to take interest rates to 4%. They do a cut in interest rates. And what does that do? So in our scenario, Larry the landlord says, I'm struggling right now, but interest rates were 8%. Now I can borrow money at 4%. So how about I take a little loan just to get me through this rough patch? Big box store says the same thing. We're not doing too well. They are encouraged to take a loan, and so is Terry the tenant. So in an ideal situation, because money is cheaper, right? Everybody in our group here would just borrow a little bit of money so Terry could pay his rent, and then the landlord would take the money to the big box store, and the big box store would take a loan so they could pay Terry's salary. And if everybody does that, it gets us back into the green, right? So money's circulating again. All right. So everybody follow me. If you are not, let's see. I don't even have the chat open, right? Are we good? I think it was good. Got no questions coming in right now. So I want to make sure I don't lose anybody before we go too much further with this. All right, we're fine. So let me bring this back up. All right, so that's one way. And if that doesn't work, if the lowering of the interest rates doesn't work, then we'll come over here and we'll just drip some money down on everybody. So it's called quantitative easing. I love how they use that term that really doesn't make any sense to me about quantity and easing, but it's essentially the printing of money, right? So we're going to come out here and we're just going to inject some money. So when we had this, we had the PPP loans, which that was part of the lower interest rates and getting capital into people. But we also just had stimulus checks, right? Stimulus checks come out. And why would they do that? Why would they just come out and give everybody money? Well, it's to solve this problem of continually being into a downward spiral in the economy. All right. So they come out and they just give everybody money. So let's say if Terry just got some extra dollars, right? He got a nice $600 check. And, you know, same thing with the Larry, the landlord, you know, everybody's got a little bit more money. So now they can start spending that money, sharing it in our economy. All right. So that is how the government attempts to spur growth, right? They're really trying to get the economy growing when it is naturally contracting. They can also do the opposite of this. Okay. So let's talk about that a little bit now. So now let's say rates are at 4%. And if they determine that the market is a little bit too hot, right, the prices are going up and we got inflation or something like that, well, they could take those rates from 4% to 8%. All right. Now we're going in the opposite direction, saying the economy is doing too well right now. Let's go ahead and slow things up and increase these interest rates. Also, when it comes to money tightening, they can buy bonds. I don't want to go into this to a lot of detail about how this process works. The government issues bonds, Federal Reserve buys those bonds, or that's essentially how it works. Or the Federal Reserve can then sell their bonds back to the government and take money out of the system. But just understand that the Federal Reserve has the ability to inject money into the system or to take money out of the system. So if they were to take money out, now it's basically giving everybody less money. How does that look? It's going to look like when the government comes out with their budget for the quarter, right? Everybody's going to have less money, less government spending, and then everything just sort of trickles down from there. So we've got putting money into the economy, taking money out of the economy, lowering interest rates or raising interest rates as the only two tools that they have. And I want to make sure that that's clear to everybody so you can it's going to build a foundation on what I'm going to say next. All right. So if we understand that, I've wowed you enough with my great drawing right here. Now I'll go ahead and stop this and we can just talk about what's going on right now. So I don't want to do that, but I do want to close my whiteboard. Okay. So let's bring it back. So where we are right now is that we've had a period of just extraordinary growth, right? Low interest rates. I mean, yes, we did have a hiccup in the economy when it came to the coronavirus and, you know, government shutdowns and lockdowns, et cetera. But we pumped so much money into the system, and we really, if you look at it on a map, it was like a glitch. It's like barely anything happened, right? Coronavirus happened, but then so much money came in and the economy just skyrocketed and took off. And so now there is this thing called inflation, and inflation is troubling the economy right now because everyone feels it, right? And so the term is, well, it's 9%, not the term, but the number that they threw out is that we got 9.1% inflation. But I'm always skeptical of things that I hear in the media and stuff that's shared through mainstream. And you just sort of think about it, though. If you've got a portfolio, did it go up by 9% or did it go up by more, right? If you owned a piece of real estate, did that real estate evaluation go up 9% last year or last quarter, or did it go up more than that? Did your gas bill go up by 9% or did it go up more than that? If you spend $100 at the grocery store, are you spending $109 now, or are you spending more than that? Now, I'm saying that this is just the way I think about it because I hear all these things in mainstream, but I actually internalize about, hey, what's going on in my life and what's going on in the lives of people around me. So the shared term is the admitted term, as some other more educated economists may actually say it's higher, right? Depending on what metrics that you look at. But regardless, it's a problem. It's a problem because if you leave your money sitting around, then you're losing money. And another way to put it, if you've got 100 grand in the bank and there's 10% inflation at the end of, say 10% inflation a year, at the end of a year, you've now got 90 grand. You just lost $10,000 and you did nothing, but every place you would spend your money at just became more expensive. So that is very much a problem. And so the Federal Reserve, the government decides, hey, we need to go combat that. And that's why you're seeing these interest rates increase the way they are. And they've been, 0.75 increase, 0.75 increase. And they want to combat inflation. And if the numbers check out and say, hey, we're doing all right as an economy, well, then they will continue to do that. So now we get to the point, well, what's happening though? So there's also the metrics of a recession. So we look, is the GDP, gross domestic product, are we growing as an economy or are we not? And so measuring that, a recession is defined as 2 quarters of negative growth. And as far as I can remember, that's been the definition of a recession. So we have 3 months and GDP goes down, and then we follow that up by another 3 months and GDP goes down. We call it a recession. And so I titled this, How to Handle the Recession That We Are Not Having. And I just want to share a document with you, not even a document, but this is an article that came from good buddies at CNBC. Let me share my screen and bring this up. So here we go. This may be a little bit small for you. Let me largen it up a little bit. But White House goes on offense to argue that the U.S. is not in a recession. And so second quarter, negative GDP growth. We just talked about that. But the U.S. economy is not in a recession. And then they go on to talk about the contraction. You got good buddy Biden right there. He appeared public twice Thursday. Both times he delivered the same carefully crafted remarks, contending that current low employment rates, coupled with new investments in manufacturing, make it impossible for the economy to be in a recession. And I could bring up the definition of recession, but it's pretty clear. If you want to look at it for yourself, it's not hard to find. Just Google what a recession is. But now you have the White House coming out and saying that we are not in a recession. And so why would the government say that we're not in a recession if the numbers do state that we are in a recession? I think that if you would look at your stock market portfolio, real estate prices, Bitcoin, everything tends to be hinting towards, the stocks are just falling. Bitcoin is, just falling off a cliff. Housing is delayed, but the writing's on the wall about where that's headed. You would sort of see the signs of a recession. So why would the government come out and say that we are not in a recession? And so the dilemma with this is that we also have the numbers of inflation. And so inflation at 9.1% is a problem. And then you have a recession, which is also a problem. And so if you remember the diagram I had with Larry the Landlord and that whole economy, when the economy is contracting, the government wants to fight off that contraction, fight off a recession, and they can only do that by lowering interest rates or printing money. But printing money and lowering interest rates are inflationary. So meaning that if they fight off the recession, then they're going to spur more inflation. But contrarily, if they fight off inflation, they're going to harm us more with the recession. And so that's the dilemma. So this is Jason's interpretation. I don't know if anybody said this, but my guess as to why they would come out and knowing that we have a pretty clear definition of what a recession is, why they would come out and say there's not a recession or nothing to see here, the economy is too strong, is because they do not want to be faced with the battle that would have to be waged, or the war that would have to be waged. I can't even talk right now. But anyways, they're going to have to do something, right? If we come out and we say, hey, we're in a recession, people are going to look at the White House and say, what are you doing to help the American people during this recession? They're going to bring up, some poor, pitiful looking person and say, hey, they can't, they're struggling, gas prices, what's going on? And nothing. If you know me, I have no knock about anybody, whether they're poor or whether they're rich. I really don't care. But I'm just talking about how the media works and the line of questioning, because it's never in enough detail, in my opinion, to truly cover the facts. They just want sound bites. And so they'll bring up some person and say, here's Timmy, and Timmy can't pay his gas or his rent. And what are you going to do, Mr. President, to battle inflation or battle the recession for him? And then somebody else, on the contrary, will talk about inflation and how damaging that is. And they just end up talking a lot, but never going into the detail and intricacies of what actually happens in an economy. So there's a decision to be made by government right now, which is, do you want to battle inflation or do you want to battle the recession? And so what the clever thing to do is, let's just say there's not a recession, right? This is my interpretation, but let's just say there's not a recession. That way we don't have to be confronted with that battle. And that way, if anybody says, what are you going to do about the recession? We don't have to do anything about the recession. There's not a recession, and we just keep on battling inflation because that's real, right? So hopefully, let me check. If I have not lost anybody yet, you're still with me. Okay, we'll just keep going. If you got any questions, feel free to drop it into the chat. I'm gonna open it up for Q&A in a little bit, or comments, whatever. We'll do a little bit of that. But I also want to share one more article, and now we're going to get into to what you should do, or what I'm going to do. Actually, I don't want to tell you what you should do. This is how I view our situation right now, and this is how I'm thinking about it. So we have a recession at play, and we have inflation at play. And so what I do is I go look and say, have we ever been here before? And if we've been here before, what happened then? And if I can look and research to see what happened then, well, that will give me a good indication, or at least some tools to go off of about what may happen now. So I'm going to share with you this article from The Balance. And in this article, they talk about inflation, and it really gives an inflation by year. So let me just share it with you right now. Okay. U.S. and world economies, U.S. inflation rate year by year from 1929 to 2023. And so I'll spare you reading through this, but this is a great article. I mean, it's got a lot of good information here. This is what I really want to focus on. So they have this chart. We've got the year, right? That's pretty self-explanatory. We've got the inflation rate for that year, column 2. We got the Fed's fund rate, and this is just what the federal government's saying is a rate, or not actually the true interest rate that you may get for your loans, but it's just what the Fed says we want the Fed's fund rate to be. And then this is the business cycle or events. Okay. So let's go all the way down here and let's look at where we are today. So 2022, we've got 9.1% inflation. and we've got a Fed's fund rate of 2.5%. All right. So just a year ago, Fed's fund rate 0.25%. And now it's 10 times what it was a year ago, 2.5%. And we've got this inflation. So what I think to myself, all right, when's the last time we had inflation right here or around double digits? And if you look at this chart, you got to go back, 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 you got to go back. All right, we're already at the 90s, but we haven't had, all right, we got a scare in here. Did I just go too far? We haven't had inflation this high in about 40 years. Okay, 40 years. When you get to early 80s, late 70s is when you get the last time this happened. And so what happened here? All right, this is very interesting to me, 1980, because we had 12.5% inflation and we also had recession. And so looking at this, you want to sort of get an indication about, well, what would the government do? What's the bigger concern? Is it inflation or is it the recession? But during this time, I'll just tell you the story. But there's a guy by the name of Paul Volcker. He was head of the chair, and he saw this inflation beast, and he did something that was very unpopular. He took rates. This is the Fed's fund rate. This is not actually the rate that you get on loans, but he took the Fed funds rate up to 18% and said, we will not have any more inflation. So you saw they went up to 10%. I mean, let's go back to 77. So look at 1977. Not too bad, but inflation is a little high, and the Fed's funds rate is very close to what the inflation rate is. Inflation goes to 9%. Fed funds goes to 10%. Inflation goes to 13.3%. Fed fund goes to 12%. We can't get inflation down through these interest rate increases. We went from 10 to 12, and inflation kept right on going. So Paul Volcker comes in and says, you know what, we're going to beat this thing, and I'm going to jack this rate up to 18%. 18%, it goes up, and we get inflation down. Now they eased up a little bit, but kept the Fed's fund rate above that of inflation. And then it went down to 3.8%, and then it continued to go down. So it normalized through the period of about 3 years. If you will look at that chart, there's a lot of that. That's one chart, but there's also a chart of just the history of interest rates. If you will look at that chart, what you will see is every time the interest rates go way up, they usually come back down shortly thereafter. So what am I saying? Why am I telling you this information? We're in a very unique position right now where the government has to make a choice. Do you want to battle inflation, or do you want to battle the recession? History would show that they would consider inflation a bigger threat than a recession. And it's sort of playing out a little bit now by the fact that they're downplaying the recession indicators that we're already getting. So if that's the case, if the Federal Reserve, and Christian says it's spot on, it's one of the other, Jerome Powell made it clear that price stability. Yeah, definitely. Price stability is their focus. Yeah. So they're giving out hints right now that are saying that, hey, we think inflation is a bigger problem than the recession. If that holds true, then that chart that I just showed you where interest rates went up to 18%, I don't want to scare anybody, but that if they decide that they're going to beat inflation, they may have to do something that drastic in order to get inflation down. It's just the reality. And so I've talked to a lot of lenders, and I think that we may have been playing ourselves with hoping like, hey, they're going to raise interest rates and eventually something's going to break and stock market will crash, and then they'll lower it back. And so we're just going to have a little bit of an interest rate increase. And maybe that happens. But if they really decide, hey, we have to beat inflation, who knows where interest rates are going to go? they'll just keep going higher and higher until they get it under control. Now, on the other side of that, if they decide, hey, we want to help the economy out, then this will just be a small blip where interest rates went up a little bit, and then the Fed will come in, lower rates because the stock market's going down and housing market's going down. And they will come to the conclusion that let's just drop rates. Maybe we have to stimulate the economy a little bit more. If that happens, then you're in the small window right now, and then we're going to see everything skyrocket again. And that honestly could be that's dangerous as well, because we could have a market crash, and a market could actually crash up. So Jason, how does a market crash up? Well, if everyone sees that inflation is at 12 or 15% and interest rates are very low, or there's more money printing going on, people just don't want cash anymore. So I don't care what the return is, just get me into something that is an investment. I'll overpay for that property or for that stock that's good, whatever it is, right? So that's how a market crash up could happen. If you know this information, now you have a very unique set of skills, right? To basically understand this, to say, all right, here's what I think may happen, and they're going to go out and beat inflation. And so this is why I love being in apartments, because when you are in apartments, one, you're doing deals for cash flow. There's never been a better time to only do deals for cash flow. So if you're buying right now, everything that you buy should be for cash flow. And that way you don't care necessarily about what happens to the interest rates. If you're I would not touch anything with a floating interest rate, nothing that's secure. Or if I did do a floating interest rate, I'm definitely buying a cap, understanding this information. So should you sit on the sidelines and do nothing? I would say absolutely not, because this is where millionaires are made. This is where the people who roll out of these recessions come out, and all of a sudden they're at levels and heights that nobody could see, because they saw this information ahead of time. If they truly choose to just combat inflation, we're going to see prices come down and down and down. But if you also look at history shows every time that they have gone up drastically in interest rates, it lasts for about, call it a 1 to 3 year period. And then they reverse the whole thing. Then they reverse it and they lower interest rates. So if you're just looking at a property evaluation perspective, right? If I buy something right now on the way down, and I understand that they're probably going to lower these rates from where they are today, I just want to get into something an asset that will pay me to hold it. I want to get paid while I hold this. I'm going to ride this market on the way down. And when they do what they've done historically and go back to having lower interest rates, then I'm going to be set up, and my property values will go double, maybe even triple, whatever, right? And so in the last downturn, 2008, everybody who bought in those years following that got paid enormously. They did extremely well off of their investments. They just had enough understanding to go out and buy stuff at a time when everybody else was scared. And so if you can just understand the basics of apartment investing, stick to locked in fixed interest rates, stick to cash flowing assets, you can ride that wave. And once you come out on the other side of it, you will be in a good place. So I'm done. Man, that is 39 minutes. I got to learn how to make these things shorter. But Q&A, if you got something you want to hop in the chat, comments. This is just my opinion, right? You don't have to take this as truth. Just wanted to share with you how I'm thinking about this, and get your comments or feedback on what you think about this. Let's go. So I'm gonna put this down. Let's see what's happening in the Facebook group. Do we have any comments there? Love reaction. Appreciate the love there, Tom. Tiffany, appreciate it as well. Nothing. No questions, no comments. Okay. Outside of that, all right. So we got a few minutes here before we close it out. Brandon, thank you for hopping in, man. Nicole, I know we had some conversations too. I guess I made that crystal clear, or everybody's asleep. What one of the other, but here's what I know. I hope that was clear. If you really grasp it, you can understand that this is a great time. Like, I'm really excited about this time right now. And I hope that what I shared was helpful to you so that you can go ahead and try to use this as a powerful tool to be able to go ahead and implement it into your investing strategy for years to come. Deborah says, I love the class. Could I have a replay? Sure thing, Deborah. Just reach out for now. Can you post Facebook link on future sessions? That's what Jim says. Yes, I'll try to get that incorporated into the emails that go out. So if you'd rather join on Facebook, you can do that as well. Any other questions, comments, concerns?
Hey, Jason, this is Christian.
Hey, what's up, Christian?
First, very well done. I think you outlined it in a sort of concise manner, right? I think the Powell and central bankers are definitely looking at either really combating a recession that we're currently in or focusing on price stability. And I'd say overall, I think when I think about my investments, I too try to understand if we have been here before. So I think your strategy of trying to understand what was done in the past, right? You mentioned the Volcker shock of the 70s. And a lot of people are starting to say that where we are currently is very similar to where we were in the 70s and the 80s, right? So I think that studying history is always definitely a great way to try to understand the steps that the Fed may take in the future.
Absolutely, Christian. Thank you for that, man. Got a couple questions from my man Kwame. Have you seen sellers reacting to these changes? Do you see them holding on to properties longer? I think that sellers are pretty optimistic right now, but reality is starting to hit them in the face a little bit. And I think that there's just more a willingness. If a seller wants to sell a property, I think that they're coming around. It's going to be slow because we still have supply chain issues. Real estate is still one of the best assets that you can be in, especially compared to everything else, right? Stocks or Bitcoin or something like that. But I do see the tide changing a little bit. And you have to understand with real estate, it's a lagging indicator. So if there's a property under contract right now and you've got 30 days, or in the commercial world, even 60 days before you'll see that data. So watching what happens over the next quarter will definitely give you a better indication over what's happening right now. Yeah. 70% of the circulating currency was printed in the last few years. Yes, I've heard the same thing. I don't know the exact number, but I've heard it from a few people who are like, yeah, the amount of money that they printed out is crazy. So that's inflationary in itself. Cool. Anyway, thanks for that comment,
Jason.
Yes.
Yeah.
Yes,
so
sir.
I think as a investor, I like to do things creatively, as you know. I think if you're a buyer, you have to you still have to stay true to your underwriting, but I think also there as sellers, they have to start realizing that these cap rates are, I don't want to say they're not sustainable, but they're hard to justify, and so cap rates are going to definitely, I've already seen them starting to rise a little bit. But I think the sellers, if they want to achieve a certain target in their sales price, there's going to have to be some. You can write into your agreement that there's going to be some shared pain or some shared suffering, so that, if they really believe that their property is worth that, then I would say, okay, fine, Mr. Seller, we're going to set aside a certain amount for the differential in interest rates for the first couple of years. If you really believe that that's going to come down, and if it doesn't happen, then interest rates don't come down, then that money goes to me. If they do come down, it goes to you, or somewhere in between. Just like in the pandemic, if you were selling a building, a lot of people were really forcing you as a seller, because I just sold a apartment building in DC. They were forcing it. They were requesting that we guarantee the rent roll for the next 12 or 18 months as a hedge against COVID. People moving out, not being able to re-rent things. Especially depending on what kind of and we had a lot of young professionals, and so because of the price of living in Calorama, they couldn't afford really to do that on their own salary. So oftentimes we had, in these 2 or 3 bedroom apartments, we'd have 2 or 3 different people that got together and would come in and buy it. Well, when COVID hit, nobody wanted that anymore, so that made it really difficult to for a while to get because we never had any vacancies. Suddenly we had vacancy, and suddenly it was harder to find people who were willing to live with another roommate or whatever potentially and get COVID, and then they would be. So I think there's going to be a lot of opportunities for some very creative financing as a buyer. And I think you just have to be disciplined, and I think you have to be patient, because there's no way there's not going to be more deals happening now.
Yeah. No, I always enjoy.
Yeah.
No, sorry, I cut you off there at the end.
No, I just think that there's still, if you're in a Calorama and Washington D.C. area, if you're in like what I call the 100% zone, you're probably still going to get your price. But on some of these other areas, as you go farther away from the very top part of a city or whatever, I think you can have more ability to negotiate your transaction in a way that hedges your bet a little bit, and the seller has to take some risk too. It can't just all be on the buyer, either in the form of cap rate or interest reserve or guaranteeing the rents or whatever that may come along. Because, hey, we're going into September. People are talking about, we're going to have another COVID. We got monkeypox. We got something else. It's always going to be something. So, but I think the big difference that I see right now is this is not like any of the historical stuff that you put up on the screen, although that was really good stuff. First of all, we have a huge delta between that 13% inflation and 12% federal fund rate or whatever you had up there. We're really upside down on that. We're at 25% of inflation in terms of the federal funds rate. But we also have the potential for World War III. And we have, supply chain disruption. We have a lot of things that are going to impact things like high-tech jobs. I'll just put this one guy that I follow, if you guys want to go watch a few of his YouTube videos, just like Jason's thing was very educational. And I recommend watching some of his YouTube videos to learn about what's really going on around the world with supply chains, oil, housing, agriculture.
Definitely.
Those you will learn way more watching him than you're going to ever learn watching the news, because he just deals in facts, supply chains, oil prices, the wars, why they're going on. I'm going to check him out. We have a lot more things to in summary, we have a lot more things to factor in than just having a crappy economy, because I'm old enough to remember Jimmy Carter in those years, what it was like, 18% mortgage rates, So when people survived and what happened is a lot of people just got very creative about the way they did things. There's a lot less transactions, but there's a lot more creativity. So.
Yeah, no, I really appreciate that, and I what I say, I always enjoy talking to you, Jim, because you always provide such useful information. But I don't want to look over something that you said. I want to make sure I got it. So you're saying that right now you structure deals where you put in a clause so that you as a buyer are benefiting or the seller benefits or loses based off where interest rates go. Is that what you're saying you were doing right now?
Yeah, so we're seeing a lot of deals that are difficult to get to the finish line in the last couple of months because in the last couple of months we've gone up 150 basis points, right? And so deals that were struck in May when interest rates were 4% still, they're not getting those from anymore. So there has to be, just be careful about how you write your contracts in terms of that your financing has to meet a certain criteria for you to execute, or, you have some room to renegotiate.
No, I really like that. I think that's a great idea, right? Of just trying to put something in the contract about, especially you got in some instances, you got 30% or 30%. You got 30, 60 days, right? And that a lot can change in that time, especially if it's around the time that the Fed is going to, come out and increase rates or doing something. Christian gave a great comment where he talked about they would invest in final. Understand this. He says that he was invest in final, about to buy a deal. Price guidance was 41 million going into best and final, and it dropped to 36 million. So that's a $5 million decrease, in just a few weeks based off movements in interest rates. So I think that's good. Very indicative of what's happening.
Yeah. Also, Jason, I just encountered one looking at a very large portfolio in Texas, and the guy had his price, and then but he had the reason his price was so high was because he had a huge defeasance or prepayment penalty. And when interest rates were going up, his defeasance was coming down. His prepayment penalty was coming down because interest rates were going up. And so his price also came down, in this case, by 5 million already. So it could come down another 4 or 5 million, And so that's really something to talk about. If you're buying a property and the guy has, a huge prepayment penalty defeasance because he got a 3% interest rate 4 years ago and it had a defeasance, but now the banks want that money back. They don't want to get 3% anymore. So, they're much more willing to negotiate, and the seller's much more willing to come down on his price because he doesn't have the penalty. So it's really important to know what the seller is into that property for, and you have to do a little bit more digging around to find that information, but it is available. But that's key to getting the best price in this market.
Great information, right? No, it's definitely time to sharpen the pencil, and those who do it, I feel like you're going to do very well during this market shift. So that's what meetings like this, or surrounding yourself with people like Jim and Christian and Angel who are all doing deals right now. That's the benefit of it, right? Because you're like, all right, what's happening in the market right now, and how do you strategize and secure yourself during this time? So this was great. I think that we definitely got a lot of good information out of this. And I said 30 to 45 minutes. We went a little bit over today, but we had a lot to cover during this topic. So for anyone who's listening, glad that you're here. I'll be here next week. We're doing these weekly now, so we'll have more content, more topics that we'll talk about. If you're interested in joining the Multifamily Code, that's a Facebook group that I have. Just go to facebook.com, type in the Multifamily Code, and we have conversations like this that's going on right now, but there are also other tools and information that I share out periodically, and just really generating a group of people that all help each other succeed in that Facebook group. So other than that, this has been a great conversation. I appreciate you all taking time out of your busy Tuesday, and make it a great day on purpose, because you deserve it. And I'll see y'all later. Take care.